Listen to me. If you are self-employed, whether you are a consultant, a freelancer, an independent contractor, or running a small business out of your spare bedroom, and you are nearing retirement, we need to have a serious talk right now. You are facing a completely different financial reality than someone who spent 30 years climbing the corporate ladder. For decades, nobody was automatically deducting money from your paycheck into a 401k. Nobody was matching your contributions. There is no corporate HR department sitting you down to hand you a golden watch and a pension. So, where do we start? We start by choosing the right vehicle, because standard individual retirement accounts, or traditional IRAs, are simply not going to cut it if you are trying to make up for lost time. If you put money into a standard traditional or Roth IRA, you are capped at a maximum contribution of $7,500 a year, or $8,600 if you are age 50 or older. Now, $8,600 a year is better than nothing, but if you are starting from scratch near retirement, that is not going to move the needle fast enough. You need to supercharge your savings, and the tax code allows you to do exactly that if you look at self-employed retirement accounts. Your first major option is a SEP IRA, which stands for Simplified Employee Pension. This is one of the easiest accounts to set up. It behaves just like a traditional IRA where your contributions are entirely tax-deductible, meaning you lower your current income tax bill while building your nest egg. But here is the beauty of a SEP IRA: you are allowed to contribute up to 25% of your net self-employment earnings, all the way up to an absolute maximum of $72,000 a year. Think about the power of that. If you have a banner year in your business, you can shield a massive chunk of that income from Uncle Sam and dump it straight into your retirement fund. The drawback? A SEP IRA does not allow for standard catch-up contributions for those over 50, because the IRS views all contributions to a SEP as employer contributions, not employee deferrals. If you want the ultimate heavy hitter, the absolute gold standard for a self-employed person trying to catch up fast, you need to look at a solo 401k. Sometimes this is called an individual 401k. This account is designed strictly for business owners who have no full-time employees, though your spouse can be included if they work in the business with you. The solo 401k is a financial powerhouse because it allows you to contribute to the plan in two distinct roles, as the employee and as the employer. You are wearing both hats, so you get to double dip. As the employee, you can defer 100% of your compensation up to $24,500 a year. But because you are 50 or older, you get an extra catch-up contribution of $8,000. And if you happen to be between the ages of 60 and 63, the tax laws allow a special super catch-up of $11,250. Then, you switch hats. You put on your employer hat, and your business can contribute an additional profit-sharing amount of up to 25% of your net self-employment earnings. When you combine the employee portion and the employer portion, your total contribution limit can go all the way up to $72,000, plus your catch-up amount. We are talking about the ability to legally shelter around $80,000 a year from taxes while building a massive retirement fund in a very short period of time. Now, I know what some of you are thinking. Susie, I don't have $80,000 a year to put away. I am struggling just to find consistency. I hear you, and that is completely okay. The magic of both the SEP IRA and the solo 401k is total flexibility. There is no mandatory minimum contribution. If your business has a rough year, you can contribute zero. If your business has a spectacular quarter, you can maximize your contributions. You are in total control. You decide what you can afford based on your cash flow. If you are starting late, you must also be incredibly strategic about tax diversification. Do you want a traditional solo 401k or a Roth solo 401k? With a traditional account, you take a tax deduction today, and you pay taxes when you withdraw the money in retirement. If you are in a high tax bracket right now, this is a beautiful way to lower your tax bill today. Once you pick the account, you have to invest the money. Do not open an account and just let the cash sit there. Cash does not grow, inflation eats cash alive. Because you are closer to retirement, you cannot afford to take wild, speculative risks. You shouldn't be gambling on highly volatile assets or individual stocks that could tank tomorrow. But you also cannot be so terrified that you put everything into low-yielding certificates of deposit that don't even keep up with the cost of living. You need a balanced, defensive growth strategy. Look at broad market index funds, exchange-traded funds, and high-quality bond funds. You want a portfolio that gives you exposure to the growth of the economy but keeps a solid cushion in fixed income so a sudden stock market downturn won't wipe out your plans right before you want to step away. Here is your actionable takeaway for today. Do not wait until next tax season to think about this. Your very first step is to look at your business structure and determine if you have any employees. If you are a true solopreneur, call a major, low-cost brokerage firm like Vanguard, Fidelity, or Charles Schwab and tell them, I am self-employed and I want to open a solo 401k. They will help you fill out the paperwork. It is incredibly simple and it costs virtually nothing to establish. If you do have employees, ask about a SEP IRA instead. Once the account is open, set up an automatic transfer. Even if it is just $100 a week or 10% of every invoice you clear, automate it. Make saving for your future a non-negotiable business expense. You pay your utilities, you pay your software subscriptions, you pay your suppliers. It is time to start paying yourself first. You have spent your life working hard for your money, taking risks, and building something of your own. Now, it is time to make that money work hard for you. Do not let fear paralyze you. It is not too late, but you must act today. You have the power to secure your future, so take control of your financial destiny and build the retirement you deserve.